Let's take a look at 5 immortal Canadian dividend stocks. As many of you have been aware, if you've followed the channel, I've been covering a lot of the Canadian stock earnings. And what I love doing is coming into Vanguard's FTSE Canadian Index ETF. The ticker is VCE, and it auto-weights the largest companies in Canada by market cap, very similar to the S&P 500, Vanguard's VOO. And we can see Royal Bank, Toronto Dominion Bank, obviously the 2 largest banks in Canada. We've been reviewing some of these. We talked about Shopify, but I want to look at some of these other stocks. We've seen Canadian Imperial post today. I'm going to review some of those earnings. I want to talk about the railways, Canadian Pacific, Canadian National Railway, 2 stocks I haven't touched on in a while. One's outperforming, one's definitely underperforming. We'll take a look at some of the utility sectors with Fortis, and I also want to talk about the most boring of stocks that has absolutely crushed it. I mean, there's no disruption to this. We're talking about Waste Connections. So if that's a conversation you'd appreciate, hit that like button, because first and foremost, Canadian National Railway, this is one that I've been wanting to add to my portfolio, and it looks like we're kind of getting a bit of a dip opportunity. They're claiming the fires in Canada have been largely affecting their earnings. We're going to review in a moment. The stock's trading down 6% year to date with a starting yield of 2%. This company is really robust. 10 years ago paying 22 cents a quarter, today paying out, almost 80 cents. I mean, we're talking about over a tripling basically of the dividend, which is really nice. This company's railways span from British Columbia to Nova Scotia, pretty much down to Texas. Really an integral part to the entire shipping industry. Here's the overlay of all the railways, and we're going to look at Canadian Pacific Railway here as well, which is the brown line, which actually spans a lot farther, and we can't really see it here because it's also part of the Kansas City Railway. But nonetheless, taking a look at the earnings here, they've seen a pretty dramatic decline, in my opinion. Not something I want to see, considering most companies in Canada have actually been having record revenues, even in the struggling higher interest rate environment. Telecoms, banks, they've been all hitting record revenues, whereas this one is declining, and we can see almost every aspect has been primarily on the decline, with a few exceptions here. If we take a deep look here, coal, for some reason, in the toxic world of burning coal, somehow that is still going up in the shipping industry. We can see grains and fertilizers have been increasing, but otherwise, outside of automotive, which we all know car prices have been going up. We've been seeing it in the earnings of, a lot of like GM, Ford, Tesla, like their revenues have been crushing, but we can see automotive shipments have been going up, which is pretty interesting in this weird high interest rate environment. It seems kind of counterintuitive, doesn't it? And in comparing it to Canadian Pacific, Kansas City, because we know we have the merge of their acquisition with Kansas City, that railway system, but we can see this company here today is actually up 5%, has actually been crushing it, steady up to the right with a much lower dividend. I don't like this one as much. It's more of a growth vehicle than it is a dividend vehicle. Even though 10 years ago, the dividend was 7 cents, today it's about 19 cents, also tripling up the dividend. They haven't provided very annual, increases, but again, you're getting such a good growth vector there. I mean, take a look at the 5 years, up 96% compared to Canadian National Railway that's only up 31%. So there's quite a variable difference here. But taking a look at what they've done because of the acquisition of, Kansas City Railway, we can see that, they span all the way similar to Canadian National, from all the way from British Columbia, to Nova Scotia, all the way down way past Texas, all the way down into Mexico. And this was only thanks to that recent acquisition. But taking a look, because they just completed that, by the way, it's like literally the longest spanning railway globally, I think. It's pretty incredible. But total revenues here sitting at $3.1 billion versus $2.2 billion this time last year. And basically every aspect of this business up, with, who cares about fires? The fires in Canada haven't affected them clearly because materials, equipment rental, like everything about this business has been going up essentially. So they've been absolutely crushing it. And I'd love to know what you think about the railways. There's something that I've been wanting to add to my portfolio. And do you think it's better to own both? Do you think I should just buy Canadian National? Or do you think Canadian Pacific Kansas City is also a proponent that I should be putting in there as well? Now back to the banking sector. I know I've been beating this drum, and talking about this relentlessly, but Canadian Imperial tanked on earnings. And by tanked, I mean, it dropped 3 or 4%. Nothing too dramatic, back to the recent lows that it experienced. Now paying a 6.6% yield, which I think is surpassing Bank of Nova Scotia's yield. And this one, even still, very consistent. I mean, from 47 cents 10 years ago to about 87, just doubling the dividend. I think actually it's been doing a bit better than Bank of Nova Scotia on the dividend increases. They reported, again, a record revenue for the quarter. I mean, $5.8 billion versus $5.7 this time last year. But I think their loan loss provisions are up like 200 or 300%, which is what's been giving them a lot of negative headlines. But what I want to talk about is the gross impaired loans. This is the conversation of choice when it comes to mortgages, credit card debt, all that stuff. Are they increasing? And I want you to just analyze this chart. It's very interesting to see the total impairments for Q3 of 2023 are about 0.48%, which is pretty much where we were at during the pandemic, which is actually fairly nominal, which is what I'm stating. It doesn't look like the economy is falling apart here. And actually pretty much every aspect outside of business and government loans are seeing some of the biggest impairments here. But honestly, most of this is pretty nominal. And Canadian residential mortgages, most intriguing, are actually in a better place because there's only a 17% impairment over 0.17 versus 0.30 in the pandemic. So technically the mortgage and real estate market, according to Canadian Imperial, is stronger than where it was during the pandemic. Now, keep in mind, they have over $250 billion in mortgages outstanding, and $37 billion isn't a huge percentage of that, but those are the people that are going to feel the infliction of the higher interest rate environment. So it'll be neat to see in the coming earnings how that $30 billion is affecting kind of the delinquency rating. And again, going back to this chart, right, if this is going to increase over time. But again, everything looks very healthy and unusual from what you'd be hearing on regular social media, which again is why I loaded up on the banks, why I see this opportunity, why I've been beating this drum so damn relentlessly. Now, Waste Connections. This is one of you guys commented on my videos about, and I don't talk about it very often. It's very similar to Waste Management, but oh my God, has actually outperformed Waste Management. And look at this consistency here. My God, since 2009, you're up over 1,000%. I mean, we're talking tech company like return, but unlike tech companies, there's no innovation required here. This company, you know, they have a consistent business that's probably undisruptible with dividend increases kind of all over the board here. Yeah, the dividend 18 cents 5 years ago, today 34 cents, doubling the dividend in basically 5 years. Super cool, but super inconsistent as well. I imagine there was some kind of a split here. I'm not sure what the inconsistency was. At least you're getting a reasonable dividend growth. Yeah, it's starting at 0.74%, but my God, that comes with exceptional stock valuation gains. Now, when it comes down to this company, guys, I think they're the third largest solid waste management company in North America, mostly spanning in the US, but oh my God, guys, 23,000 employees, 18 billion plus in revenue. I mean, $17 billion in assets. It's a pretty astounding company, right? Taking a look at those revenues sitting at $2 billion versus 1.8 billion this time last year for the quarter. On the 6 month ending, 3.9 billion versus 3.4. Very steady, consistent growth. As the economy scales in Canada, as the economy scales in the US, this is a company that is just a necessity to life, and they can continue to prove it. It kind of reminds me of when Bill Gates was, he has Waste Management in his portfolio, and sometimes just owning the most boring of boring companies, the most reliable things when we're talking about toilet paper with things like Procter & Gamble to, these waste management companies, it's just, you can't really do no wrong. They have like the lowest risk, they're the most recession proof, and they continue to outperform in tougher market environments. Now, when it comes to things like Fortis, you have to be a bit concerned on the utility side of things because the higher debt, but Fortis has been proving they've been able to manage it fairly reasonably here, and yet the stock is still trading down about 17% from recent highs. But this one we're buying for the dividend, right? This one's not giving you the same kind of growth vectors. It's very steady and stable, kind of reducing some volatility, but you're getting a 4.26% dividend in this current moment. The dividend 10 years ago was what, 31 cents, where it sits today at 57. So not nearly the same growth as some of these, more literal growth vehicles with the railways, with Canadian Pacific or Waste Management. But again, we're talking about a much higher starting yield. It's good to build a portfolio of combining assets of growth and dividends. It's not good to just focus on higher yield, or you'd give up some of those major returns out of those other stable companies. Now, this one is probably still one of the Canadian favorites in the utility sector. I love that 93% has basically transmission and distribution assets. They're moving into the renewable space. I don't think I need to talk about this much more, as I'm sure every Canadian is aware of Fortis, but just taking a look at how they've been doing from a revenue standpoint, they've seen a nice increase, 2.59 billion versus 2.4 billion in 2022. Year to date, crushing it here, almost at 6 billion versus 5.3 billion. No real complaints across the board. Again, they've been managing debt well. Net earnings have been going up. Everything about this company remains steady. They look to grow the dividend at about a 4 to 6% rate, I believe. So not the same kind of dividend growth they had in the past, but still, just taking a look at the earnings are great. They have room to pay the dividends. It's just one of the most stable utilities that currently exist on the market. But I'll pass the question off to you. I'd love to know what you think about these 5 immortal dividend stocks with very long track records, very stable growth, and will likely continue to in the future. What ones do you think I should add to my portfolio? Because I like all of them, but obviously I got to make the money to be buying them. So yeah, just let me know your thoughts.